RBI rules for brokers and market intermediaries has created a flutter amongst broker body. ANMI has written to central bank and sought a 6-month freeze on the new RBI rules that relate to bank funding to stock brokers and market intermediaries. To discuss this and more, we have an eminent panel of guests today joining us, and also my colleague Ankur is joining us in the studio today on the 6-month freeze and the request that ANMI has, as a broker body, has made regarding the RBI rules. Take it over, Ankur.
Yes, and this is the brokers body actually now requesting that regulators should take a look, and definitely there should be some kind of relaxation. In fact, the rules which are supposed to be implemented from 1st of April 2026, there is a request that there should be freeze on the same. And why so? Because brokers body think that regulators should consider some relaxation. To discuss about this matter, as Shivani mentioned, we have two eminent guests with us. Let's connect with K. Suresh, National President, ANMI, as well as Mr. Ajay Bagga. First of all, I want to come to you, Mr. Suresh. You have now requested regulator for some relaxation. I want to understand why have you written letter now, and what is the ask from regulator?
Sir, the issue is that when you go through the final print, we found that a lot of things are there which are detrimental to the community, in the sense the ecosystem of capital market. The capital market system is affected. Not only our community, the entire system will be affected because of new things which have been designed in this model. See, nothing wrong in shifting from discretionary method to what is called structured loan method. Nothing wrong in that, but the way in which things brought in will, skews the what is called the cash flow of the entire community. So that that is the major issue which we feel at this juncture, because already STT increases on the one side effective from 1st April. This is also from 1st April, means too much strangulation at this juncture, which is not good for the capital market as well as for my community people also. That's why we thought it is necessary to take up this matter with the RBI and request them to defer it for 6 months at least. Then we will have a dialogue. That dialogue really will definitely give a fair idea to both sides, and we can easily sort out the matters. That's the whole thing, sir.
Definitely. Mr. Bagga, I want to come to you about the issue. Now, the larger thing is that as far as government is concerned, we saw STT, which was imposed. Before that, FNO norms were brought by SEBI. And idea is that there should not be much of speculation, but actual market making. And that is the word which has come in from government and the corners we have spoken to. How much of the fair ask you think is there by the brokers in asking for relaxation, according to you?
Yeah, 3 points to it. Overall, I would say it's a very fair ask, because any such big change that you make in the markets, it must be grandfathered. Time should be given to market participants to rejig business models. So that's the first point. The second, I would say, overall exposure of banks, if you see, to the broking community is about 1.5 lakh crores. It's a pretty big number as far as the markets go. See, if you see last year, we raised 1.9 lakh crores in terms of IPO money. Primary markets raise was 1.9 lakh crores. So that dimensions the scale of the issue. Out of this, nearly about 50% of this outstanding could be at risk as of April 1st. So who will provide that liquidity when this bank liquidity goes away becomes a big issue. The third will be, suppose this goes through, our simulations are showing that the bid-ask spreads will increase, the market depth will reduce. Already, as Mr. Suresh was mentioning, because of the STT being hiked, volumes are expected to be going down. So you will get less deep markets, less fine markets with larger bid-ask spreads. And also, the fourth point is, it's an uneven competitive landscape then, because foreign brokerages and foreign quants foreign algo traders can raise money offshore and bring that in as their own prop money without touching the Indian banking system and be able to operate. So the domestic brokerages come to a disadvantage. I think these are some of the valid concerns of the broker community.
Let's go on
Prop
to Mr.
trading,
K. Suresh also, and let's help us understand. Let him help us understand what unintended consequences do they foresee as an industry body if it's actually implemented on April 1st, 2026.
I think, Shivani, you said industry body. Make it very clear that our community is yet to be defined as an industry itself. Okay, there's a long pending demand with the ministry also to declare as an industry. So without that tag also, we have been subjected to so many new things in the banking funding. See, funding, okay, see, I think all of you know that without funding, nobody can survive. And suddenly, if you bring in all these new regulations, from where they will inject this much capital which is required. And particularly, for example, prop trade, you have stopped entire funding. Please understand that it is one of the constituents of the capital market who provides you the liquidity as well as good price discovery, etc. Better price discovery, etc. is happening. So when you stop that channel, what will happen? The market will have its own impact. I mean, the equilibrium of the market will be disturbed, and further, ultimately, investors will be disturbed. I mean, who will be disturbed? Investors only will be disturbed, and our own community people also will suffer because of lower income, lower volume, lower income. So then what will happen? Job will be lost by people. See, consequences are a little bit high on this side. That's why we feel that this is can be sorted out, or it can be diluted to the extent what is required. That's all.
Definitely a point taken. I want to understand from you, Mr. Bagga, which of the areas you think is of more concern. As Mr. Suresh mentioned about prop trading, which points of the order you think that if implemented will be more concerning?
Yeah, see, overall, it's all coming within the capital market exposure of banks. So that becomes a big constraint on developing our markets in the future. So you are shutting down bank finance to a large extent for the capital market operations. Already we saw that despite about 2 lakh crores of either approved or under approval IPOs, we have seen a pretty dismal January already. So sentiment is spoiled to some extent. Markets have been underperforming for 14, 15 months. And at that kind of a time, a very crucial liquidity provider in the markets is taken off by regulatory action. I don't know if there is coordination in this. In my time, there used to be a coordination of various regulators meeting under the finance ministry. So you would understand unintended consequences. Now the banking regulator has tried to safeguard banks, but we have not seen defaults to banks from this segment as such. Overall, it's a very well-managed segment with very strong risk management processes in place. So we have not seen any losses being passed on to banks per se. In that kind of a scenario, on a 1 month basis, to remove such a large facility of 1.5 lakh crores, that pulls out liquidity. So I would say the biggest issue is liquidity. You have seen the market reaction where market making companies, brokerages, exchanges, clearing corporations, all we have seen their stock prices going down. So market has already given its verdict that about 10% price damage has been done for most of these entities. Money will be raised elsewhere through CP, CD routes, through other alternate mechanisms. They will bring in more collateral. Workarounds will be found out, but time should be given. Given the sheer scale, 1.5 lakh crores outstanding today, you can't replace it overnight with personal funds.
Mr. Bagga, point taken here. In short, I want to understand from you, what is the solution to the problem? The regulator has made clear what they intend to do. The government has also said so. What can be the solution?
See, you can ensure that you're not funding speculation in the market, but these are institutional players. So, like on the prop trading, you're putting, then you define the market maker mechanism and you arrange funding for them outside the capital market, for example. So banks can lend for market making, and you keep the prop books aside. You lay down the criteria how the broker will define it. Second, I would say grandfather it. So give time to brokers to raise money elsewhere. So grandfathering is very critical in financial services. I would say give a year at least. And in that time, hold discussions, understand the ramifications, also see the unequal playing field that you are raising. With foreign brokerages, then put at an advantage over domestic brokerages, which would not be an intended intention of any of the regulators. So I would say these are a few of the things. One, postponement. Second, at least the genuine market making be allowed. And third, then look at also give them ideas on where they can raise about 50 to 75,000 crores, which is what will be needed to be raised. It's very difficult to raise it by 1st April. As I said, look at our IPO market, look at our bond market. The big guys, the bank-owned brokers will do very well. With the bank sitting behind them, I will lend very easily to the bank-owned brokers. But all the other brokers will get wiped out.
Definitely. One last point from you, Mr. Suresh, before we wrap. Now that you have already written a letter, are you also going to hold some kind of conversation with SEBI, the immediate regulator for you regarding the same? What are the next logical steps?
Yeah, naturally, my close brother is SEBI actually. So naturally, I have to take them also into confidence, and we also seek their help to convey the exact inputs to the central bank, so that central bank can understand the whole matter in a proper perspective. That's very important. So that's why we thought SEBI can also do some help for us. So we also seek SEBI's help to intervene and give their valuable inputs to the central bank, so that we can formulate in a better way the whole thing. See, we are not against a structured finance. It is one of the best ways of doing it. There's no doubt about it. But it cannot be all of a sudden. It cannot be without any proper holiday period, or some gestation period must be there to switch over. Transition must be ensured. A lot of things are there actually. Similarly, for example, 40% haircut is on equities. It is too much. I mean, almost you are wiping off 50% of the equity value just for because it's equity. No, you have to see what kind of scripts, which category of scripts. A lot of things are there. You can't say sweeping 40% on all equities. This is another simple example. Similarly, 100% collateral, and in some cases 50% collateral, 25% cash you are wanting. So ultimately, what you are doing, you are just closing. So my friend said, you are closing the doors of the bank, and you are making us to go somewhere else. Where we will go? See, banking is one of the systems available for the entire community to build up their resources, to move up, to increase their net worth, and to improve the market participation. Everything is there. So that's why, bank also plays a very good role. So we need banks' help also. So that's why we request SEBI as well as the central bank to consider our views and do something, sir, on this.
Mr. K. Suresh and Mr. Bagga, thank you so much for joining us and sharing your inputs with us. Well, on that note, it is time for us to slip into a very short break. You don't go anywhere. We will be right back.